Come on in. If you're joining the replay, we are just waiting for the live studio audience, so you could fast forward a couple minutes as we do every week for our 10,000 worldwide followers of Stock Talk Live. I am Money Mark, a 30-plus year veteran of technology research. I knew about NVIDIA back in 2002. That GPUs were going to be the future of the world. Why? Not because I'm a genius, but because I utilize the most valuable asset to a stock investor, which is independent, third-party industry experts with multi-decades of experience in their industries. And Gartner Group, who was the foremost authority at that time on GPU research, back in 2002 said, this is the future, and NVIDIA is the best player in the space. Now, it took 20 years before that actually was proven true, but it was. And this is the important thing about stocks. It's not to know about what's going on now, what happened 3 months ago when a company reports their quarter, what's going on with the stock, because stock movement, I'll talk to you about that, is BS, especially here in 2026. And so this is a ripe environment to take advantage of the dummies, the 10,000 clowns that are out there trying to give you stock picks. All right. And I'm here to help you with that. I'm just sending out the invite that I'm here. Let's see, get that out there. Share the live. Y'all veterans know what it is. Let people know that I'm out here, and we're going to get this show started in just a minute. We're already 2 minutes in, and we got a very, very busy schedule of information to provide for you today on AI. A few other names, but we really focus on AI because that's where the opportunities are. Boom. Let's see. Live now. And we're going to get this started. There we go. Send that post out. Let's see what we got for an audience. Is that enough to get the show started? We got audio. We got audio. We got video. We got video. We got audience. We got audience. That means we got a show. That means we got Money Mark Friday Stock Talk Live. We're back. We're back. For those of you who haven't seen the show in a while, you know we started the year on a different note than the past. There are important reasons for that. Go watch last week's show and just know that we've taken a big step back towards where we were last year in terms of the show format, okay, which was met with large acclaim. People seemed very happy with the new changes. If you liked the changes, let me know in the chat. If you didn't like the changes, let me know in the chat. If you have a question, put question marks, preferably 3 of them, in the beginning of your question so that I know it's a question. Do not put 3 questions in front of a comment. Do not put your stock picks in my comments. I will ban you from my channel, etc., etc. You all know the rules, most of you who are here week in, week out. But let's get to it. First of all, I'm putting the disclaimers, disclosures, whatever on the screen. You guys have to read this. Suffice it to say that if you were watching this or listening to this, that you have read this or had somebody read it to you and that you understand and accept these conditions to watching this show. All right. Important part of my ability to cover my rear end in this crazy world. All right, let's get to the macro, and then we can talk about stocks. Nothing to see here. The fear, 41 on the fear greed, pretty close to neutral. As I say every week, I don't care about the fear greed index until it gets extreme. We got to get under 10 before I even care, really. So 41 doesn't mean anything. It could go up or down from here. Unless we get above 75 or below 10, nothing really to see here. Okay, the stock market can go anywhere. Now, the 2-year yield, spiking up a little bit, but still within the range of where it's been for the last several months. So kind of nothing to see here. But as you all know, there's a little skirmish going on in the Middle East, and that's causing some havoc. Oil prices have spiked up. Interest rates you see moving like this, and stocks going down. I haven't even checked to see where the market's at right now. Today would be, whew, Russell's down 2.15% as we speak, coming off the yellow alert levels. I mean, that yellow alert, it most of the time it's going to guide the way. And here it is doing it again. Okay? The yellow alerts have been a great guidepost for decades. They have helped me generate the 40% annual returns on invested capital that I have put up for myself and my family for the last 30 years or so. 1996 to be specific, and that was just after I met my mentor, so I was actually a loser before that. Don't ask me about 1990. Don't ask me about 1994, and don't ask me about 1993, the year I graduated college, because each of those 3 years I lost money despite the fact that I came out of college with honors and a finance degree, because colleges are BS. CNBC is BS. I found out through my mentor, a Wall Street veteran who was taught by a Wall Street legend, how this really works. And it's nothing like most of the world knows. And that's why I come here every week, because this guy helped me come from the gutter, almost the gutter. I was living in a basement, not a basement apartment, a basement. And he gave me the knowledge I needed to go from that basement to the penthouse of a Miami Beach condominium. Okay? It's like Neo in the Matrix, right? So I'm here. What kind of a-hole would I be if I didn't come and pass that on to y'all? Anyways, that's my little speech. I don't know if I have any more speech today. I got information. The GDP now, no change from last week. Let me reset this just in case. Atlanta Fed now going in line with the blue chip consensus. So, which is interesting, because at one point the Atlanta Fed was looking at us doing 5%. Oh, but this is for Q1. Q4, the Q4 numbers was up last week. So Q4, I think we're looking at over 3 to 5% GDP, very healthy. And now we have the Q1 estimates coming out, and you can see even more healthy, because the blue chip consensus for Q4 ranged from like 0 to 2%. And now for Q1, it's ranging from about 1.3 to 3.3%. So an increase on average. The Fed, Atlanta Fed estimate is at 2.1, so they've come down in their numbers relative to Q4. The blue chip consensus come up relative. They are aligned at this point. So nothing to see here except to say continued health in the economy. Yes, there are weak spots and there are threats, because when oil prices go up, if you guys have listened to anything I have to say, you know that these are the two most valuable tools to being a great investor, to be making that 7 figures a year like your buddy Money Mark. Pen, notebook, and in your notebook it should tell you that there can be pockets of weakness in an economy, and the economy is still good. As long as the economy is good, we're good for the most part. You should also know that oil prices are the biggest impactor on inflation. So there is actually, and finally, I saw something that finally made sense to me, because if oil prices go up because of what's going on overseas, but the economy is not stronger, right? If oil prices go up because the economy is so strong that everybody is driving and everybody's building stuff and everybody needs oil or gasoline for one reason or the other, and so the demand for oil is up, that is the impetus for the Fed to step in and to raise interest rates, to pump the brakes, right? But people think that inflation means higher interest rates. No. And I saw an article this week that touched my heart, because it said that these higher oil prices won't necessarily stop the Fed from lowering interest rates. And in some cases, in many cases, I believe that is the right move, because this isn't a supply-demand. This isn't a demand-driven rise in oil prices. This is a supply-driven increase in oil prices. That's not real inflation in the sense of the economy is so strong that it's creating inflation. That's an artificial outside input, which, all else being equal, will actually weaken an economy, which dictates that we should be lowering interest rates into that kind of situation, not raising them. And so that's nice to hear that that might be the case. But that's the macro for this week. We're going to get right into my notes and stocks. You can see we will be talking about Marvell. A stock I told you I switched out of Broadcom and into Marvell. This is a while ago. And mainly through selling puts. Look it up if you don't know what it is. I'm not going to explain it. I'm not here to be a teacher. I'm here to talk to you about the things that I know that you don't, or that you can't on your own. Things that you can learn on your own, you have to learn on your own, and this is one of them. So I sold puts. What does that mean? As long as Marvell didn't go down from the put price, that I can make 100%. If I write a 75 put on Marvell, and Marvell just stays at 75 from now until the expiration date, I make 100% on my investment. Okay, so it's an alternative way to make money in an environment like this. When the market's moving sideways, the people who sell options can make a boatload of money. And you can look up why, ask AI, say Money Mark said XYZ. What does that mean? How does that work? And it'll teach you, right? But before we get into that, let me go through this week's lessons and notes. So I did some additional research on how this market works, and it's very valuable for all of you to know. I mean, every single one of you, whether you are a long-term investor or a day trader, all right? And here it is. I started talking about this last week. You got passive money, right? People who have money coming out of their paychecks automatically every 2 weeks going into retirement accounts, 401ks, etc. When I graduated college, that represented 4% of the money flowing into stock markets. Okay? It's now 53%. In other words, it's blind to where the market is at any given time. No matter what, every 2 weeks, money's coming out of Americans' pockets and into the market. It's flowing in, it's flowing in, it's flowing in. And because of that, it has been a great tailwind for the stock market dating back to 1993 when I graduated college. And if we pull up this chart, we go back in time, right, to the 90s. We can pull up the S&P 500 since this one doesn't go back that far. This is the Russell. Here we go. And go back one more. There we go. There's 1993, where I graduated. And you could see the market has been great. Aside from, boom, the internet crash, and boom, the real estate crash. And that little boom right there, that little teeny boom right there, that was COVID. Okay? So aside from boom, boom, and boom, this market has been booming since 1993. Well, why not? As long as money keeps flowing in and flowing in and flowing in, right? You had more and more money coming in from retirement accounts. And then you had the internet show up. And then all of a sudden you could do trading on the internet. A lot of y'all are too young to remember the days when I had to call or go to the actual broker branch live to place an order and pay $35 for a transaction. Now you just get on your phone and most of the time the transaction is free. What happens when you go from having to make a phone call or take a trip and pay $35 per trade to an environment where you can be in bed, wake up, decide you want to make a trade, boop, 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 and make it for free? The convenience factor, the cost factor has lowered the barriers, has made it accessible to everybody, and now as a result, retail investors are a huge portion of today's trading. And no offense to y'all, but you already know 99.9% of y'all aren't professionally trained on how to value a stock, how to identify an overvalued stock market. So when you see Warren Buffett go to his largest cash position ever, when you see Money Mark call the market a yellow alert, and you say, why? This is why, because we've been trained on how to value companies. And we're going to talk about companies today. But just know, as a result of this, and by the way, algorithmic trading, that's blown up since I was in college. And so now you've got a huge chunk of the market. It could be 75% of all trading out there is being done by either a black box computer, a human being who hasn't been trained on how to do it properly, or a money manager who has money flowing into that 401k program every week and has no choice because his job is to invest that money, not to decide if the stock market is too high or not. And this was where it gets interesting for you. Here's where it gets interesting for you. Because what you have seen recently has been a rotation. You look it up. The market has been rotating out of tech into staples, out of staples into oil. It's rotating. Why is it rotating? Because these money managers aren't dumb. They're just handcuffed. We have to stay 100% invested and more money keeps flowing in every week. What are we going to do? We can't sell stocks, but we think stocks are expensive. Well, sell the most expensive ones and buy the least expensive ones. And so what happens? They start getting out of tech. AI is going to kill the world. Get out of tech. And they get out of tech and they go into the staples. Walmart, Costco, McDonald's. And what happens? Next thing you know, Walmart, Costco, and McDonald's have the same PE ratio as Meta, Google, and Amazon. It's a fact. I reported that on you last week or the week before. And so then what happens? A rebound in tech. And the staples are going down. And now the oil companies are going up. And are the oil companies cheaper than they were before? Not really. Because this conflict will end and oil prices will settle down. And if you do a DCF analysis, what's happening right now does not justify a big rise in the price of oil stocks. But if you are a money manager, one thing you do feel comfortable about is that oil stocks probably won't go down in this situation. And since that's a safe place to put money, that's where I'm going to put it. Take it out of those expensive staples, put it into those oil stocks. Take it out of the staples and put it into these beaten up software names that are not going out of business tomorrow. And so you see, told you CrowdStrike, that whole craziness where the security offering announced by, I forget which AI company, made CrowdStrike go down like 20% in 2 days. And all it was kind of a bug detection for code. CrowdStrike doesn't do bug detection for code. They do cyber security to prevent intrusion attacks. Not bug fixing code. Has nothing to do with it. And so predictably, since I told y'all that, what was that, last week? We got Friday here, and what was last Friday? The 27th. Look at that. This is where we were last week at this time. 367. 429 now, mama. 17.6% up on CrowdStrike. This is how it's done. Because when you understand how the market works, who is driving the market? Retail investors, untrained. Black boxes, untrained. And money managers that have no choice but to be fully invested. It gives you a sense as to what's going to likely happen next. Okay, very powerful thing to have in your arsenal. All right, so that takes care of that. But by the way, one thing to keep in mind, right? Keep an eye on that passive money. Right? Because of those three entities I mentioned, the black boxes, the money managers, the retail investors, right? It's the passive money. It's the retail money that can come out of the market, and that is increasing. There is a growing number of retail investors that are not making as much per week as they need to keep up with their expenses, and as a result, they're either investing less in stocks or pulling back on their 401ks. It's not a big difference yet, but we're starting to see that tick up. So keep an eye on that, because that's how markets can start to roll over. And you see, this is exactly what's happened since the yellow alert on IWM. Boom, we are down what? 7% on IWM, right? And we've been on yellow alert for the S&P 500, right? For months now. The Qs for months now. Nvidia many times. And all of those things have basically gone nowhere or down for months. All right. Basically flatline. So, not like we've had a crash, but hey, there have been crashes in sectors. And if you followed the rules in your notebook, no speculative stocks, no wait time stocks in this environment, be careful, or keep them very, 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 very small. That's how you win in this environment. We want stocks that are leveraging, taking advantage of, getting a big win behind their back. Who are the next AI winners? That's what I'm here to present to y'all on a weekly basis, all right? And we got some new ones that we're working on, okay? We talked about one last week, OPTX. By the way, part of last week's show, part of the changes I've made was I told y'all that if I do a big presentation on a stock, not, CrowdStrike, I mention it, I mention a stock, listen, leave me alone, right? But if I make a big presentation on a stock, I am going to make a promise not to trade that for 72 trading hours. Well, there were 2 or 3 stocks I talked about last week. This was one of them. IZEA was one of them. I can tell you that I did not trade those stocks, not only in that 72-hour window, but at all, except if I was buying more. Okay, so I know I did buy. I was a buyer of some of the stocks that I talked about in a positive way. So I'm moving with them, with my rhetoric. That's what we're doing. And we're going to continue to do that. I'll continue to give you my 72-hour promise if I give a major update on a stock. So that helps provide visibility and transparency into my activities. I hope you like that. Little sacrifice on my part, but you know what? It was actually kind of cool. This was the first week I went through that on an official basis, right? Like really coming out and telling you about it as opposed to actually just doing it silently. And it was cool because I said, you know what? I can't trade these stocks. I went and did something else, play with my kid, all that stuff. You know what's funny? I didn't gain or lose any more. Like trading is fun, but it's not as profitable as investing. And I ended up having a better week as a result of it and making money too, despite the market going down. So that's always nice. All right, let's get into stocks. I got this note. We're going to talk about that. I've got that in the notes. Let's see if I didn't miss anything here. Okay, yeah, we just talked about that. Oh, Glenn. My man Glenn. All right. You guys don't know who Glenn is, but Glenn knows who Glenn is. And one other of you in my chat rooms. Listen, y'all. Follow the rules. Please, please, please. I don't want to hear y'all bragging about how you overweighted one of my picks and it went up. I didn't want to hear about how you decided to put most of your money in one of my picks because you think that's the one that's going to go up. No. Don't No, that's exactly what got me in trouble back in the early 90s, my friends. Okay? Not following the rules, because let me tell you something. We are all human beings. We are all driven by emotions, affected by emotions. Yes, we have a brain, but we also have a heart. And let me tell you, even me, after 30 years of experience, if you ask me to pick my number one stock that can't miss, because I'm going to put all my money in that one, you're going to get bombed on. You're going to lose. Because more times than not, I'm wrong about what my number one pick is going to be. A lot of times, my number one pick ends up being my worst pick. How is that possible, Mark? That must mean that you're a terrible stock analyst. No. That's not how it works. Because when a basketball player puts a shot in the air, you don't know if it's going in. Even if it's a great player. 70% from the three-point line, right? 70% from the three-point line. You don't know which of those shots are going in. And you don't know which of the ones will not. You just know that 70% are going to go in. So what do? You bet positive on every shot. But you don't blow your wad on one shot. You just bet positively a little bit of money on every single shot and you will win. That's called, you're going to be shocked by this word, a portfolio. All right? So there you go. That's my last sermon for the week. Everything else in my notes is about stocks. So let's get into them. Let's see what we got for y'all this week. So we got Marvell. Last time I told you, things are going to flow downstream. Broadcom is the top dog in this space, right? But Marvell is a good player in the space as well. And the direction that the market is going to increasingly assist Marvell in holding the line against Broadcom in their competitions. And whoa, 20%. I mean, the market's getting crushed today and Marvell's up 20%. All right. Now, hasn't done anything great over the last year since it really pumped up to these levels back in 2025, the beginning of 25. But look, that was the line, right? And you guys know the gray lines are technical. The white lines are preliminary, red and green lines. The preliminary green, your notes, take your notes, because you know what the red and green lines mean. Those are fundamental. White lines are preliminary, fundamental lines. And then the gray lines are technical. Fundamental lines are the ones that get you paid. Technical lines can help show you what might happen next on the way from one end of a fundamental range to another. Cool, and you can make some money that way, but the big money is made by picking great stocks near the lower end of the range and holding them until they're the higher end of the range, and that's how you make the easy money. Okay, Marvell got up here, tanked, became a better buy. It's done better since then, and now we're starting to see some of the fruits of the labor and the direction of the AI winds in the environment starting to have a positive effect on Marvell's future. Now keep in mind, right? I mean, it just, what little gap was left between here and the top line, about half of it just got eviscerated in one day. All right. So me, I am going to hold on to the puts that I sold, but I'm not going to add to the position. I probably won't get rid of the position. They're March puts, and March puts expire in 2 weeks, 2 weeks from today. So, and mine are priced at 85 bucks. So if Marvell can just stay above 85 for 2 weeks, I make 100% on my position. If not, I will take on some Marvell stock as a result of those puts that I sold, maybe still at a profit. You know what? I'll check. I'll even tell you what I paid for them. Marvell, March 85 puts. I sold those for $5.40. So let's call it $5. That means as long as Marvell is above $80 2 weeks from now, I profit on that position. And if it's above 85, I make 100% on that position and anything in between, right? Anything below 80, I take a loss on those puts, but I'm buying the stock. I'm buying the stock. If I get to buy the stock down here with the benefit of knowing what a great quarter they had, bring it on. Bring it on. And that's what I love about selling puts, because when you do it at the right time, at the right price, you almost can't lose, because people are paying you a premium, hoping the stock will go down when you feel confident that it's going up. And even if you're wrong and it stays flat or even goes down a little bit, you can still win. All right. And that's why you ought to learn about these things. But I'm not going to teach you. That's Marvell. Let's keep going. Next, Micron. Ooh. Now, if you read that headline, you know that that does not look like good news. Micron locked out of HBM4. Why? Micron has had yield problems, not like Samsung and HK Hynix, right? And remember, when I switched out of Micron into Samsung, right? I don't know how it was weeks or months ago, told you all about that. That worked out nice. I'm actually out of Samsung now. I'm sure I reported that. Made like 20% in short order on Samsung. And in the meantime, what we got with Micron is, let's zoom in, right? Over the last few weeks, the stock has been losing ground, down 16% off of its January month-end price, and part of it is because of the information flowing into the market. And by the way, Dr. Robert Castellano, salute to you, my man. He's exactly what I've been telling you about. This is a multi-decade industry expert. Bro, I can't even understand some of what he's talking about in here. I'm not going to show it all because this is behind the firewall, right? So hopefully he doesn't get mad at me that I'm advertising his services, and part of it is showing a little bit of his research on the screen. But this man does a great job of following the industry, telling you what's going on behind the scenes, the kind of stuff that Wall Street finds out about, starts acting on, and while you're sitting at home wondering why Micron's down, when Flash is through the roof, when AI is through the roof, when AI is not a bubble, well, here's why. Because they're the weakest child in the bunch, and we like to be involved with the stronger players in a space. right? And this is the problem, right? I know you like to hear about Marvell and Micron and Nvidia and all that stuff, but when you're dealing with these large cap stocks, you are competing against the best and brightest of Wall Street. These Harvard MBAs, these Wharton MBAs in three-piece suits in a 30-story building in New York City, spending 100 hours a week. That's what you're competing against. And these companies have dozens of them all competing. To me, it is a small amount of money. I have fun. I make money on these names, right? But it's not the meat and potatoes. These are not my top positions. These are not the positions that I talk about with you as my, right? Official, unofficial, whatever, speculative picks, all, right? The stocks that I like the best, that I love the risk reward on the best. Just keep that in mind, okay? Because these things might seem safe to you until you see that. Okay? Do not get lulled into a sense of security by virtue of the fact that a name gets talked about on CNBC every day, or the fact that it's a great company, because a great company doesn't mean that it is not overvalued. And you see CRM was way on the upper end of its range, right? Before the AI bad news started coming and knocked the stock down. And I feel bad. I feel bad for the investors that bought in at 369 and are now sitting here at 200, down 44% on this great company. Yes, it is. I still would say it's a great company. And I will tell you that the AI hype is overblown on CRM, right? That doesn't mean the stock wasn't overvalued at these levels or highly valued at these levels, giving it more chance of getting crushed than going up. As you can see quite easily, look at the size of that. In fact, I'll make a line for you, right? You see that right there? That's how much it's gone down. For it to have gone up the same amount, there's what would have had to done. It would have to blasted right through a long-term valuation line and go to 638. That wasn't going to happen, Jack. You took a 50-50 gamble on something that didn't have a 50-50 payoff. All right. So anyways, that's Micron. So be careful there. All right, now let's get to some real names. Let's get to some meat and potatoes. Let's get to some things we can really make money on where Wall Street hasn't picked it over with a fine-tooth comb and 50 MBAs that we can't compete against. Oh, shoot. I mean, bro, it doesn't get any better than this, right? We have played this stock like a grand piano. Grand piano, and it was very easy. All you needed was your notebook, right? Because back in 2021, I came on and I let y'all know that because of EVs, because of Tesla, because of an order that came in from onsemi, that Aehr, A-E-H-R, a $2 stock at the time, right? I was buying it here in the twos, let you know at about 3, and I let you know what? That it was an EV gold mine, that this stock was moving into the gold mine phase after years of being in wait time. Let's pull the chart back and see what happened ahead of that gold mine call. Nothing. Up and down and up and down and up and down. And then it hits gold. You know why? Because it was wait time. And then the wait time ends. And what happens to a stock when the wait time ends? Most of the time it blows up. Boom. Up. Not blows up in a bad way, blows up in a good way. And that's what happened. The stock went from 2 to 52. Right? We were getting out along the way. I didn't ride it all the way to 52, but I was definitely back in here when it became an AI gold mine. And I told y'all to get out back here anyways because EVs were slowing down, right? So we were getting out here on a valuation basis, which was cool because the stock pulled back and we had a chance to get back in at the green line, but as it got back to these levels that were, a little pricey by my measures, got out again. Too early, cool, no problem with that. We did that with Kraken too. Got out too early. Stock still ripping, right? We might talk about them as well, by the way. I didn't have them on the notes, but if we have time, I'll give you an update on Kraken later on. But boom, and then we get fundamental news that EV is going back into wait time. Well, that's not good for a stock, and it certainly wasn't. We went from 52 down to 6. And then the AI gold mine hit. So what was crazy about that is you could have bought at the green line and just had faith that something good will happen because this is a good company, right? VTSI is a perfect example because right now, just like back then for Aehr, nothing seems to be going right for these guys and the stock is at the green line level. And for Aehr, that's what happened. It got down to the green line level. Nothing good was going on for them until, right? It took really from the green line level. Let's zoom in to show you how important patience is. If you buy a stock at the green line, boom, from the green line until the AI gold mine hit, it was only a month, right? It was only a month in this case. But you still have to wait. While the stock went down, 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 you bought here at 850 and it went to 8, 750, 7, 650. And you're like, Money Mark's a freaking idiot. F his green line. And then they get the first AI order that signals the gold mine. And that's it. The rush is on. The stock goes from 7 to 37 in 11 months. A 441% gain. This is how you do it. Now, keep in mind, right? These are the risk reward lines. We still got a line of sight to 60 plus. So from 37 to 65, could still go up 75% from here. I can't guarantee that it will. All I can guarantee you is based on my calculations, here is the potential reward, 70% up, and here is the potential risk, 75% down. 75. It doesn't look that way because it's a logarithmic chart. Look it up. But you could see the box above my head clearly says plus 74% in the green, right? And then if I bring it down here, it says minus 76% in the red, 75%. It's basically a 50-50 bet in terms of profits. But no. Because the chances that this stock goes down to 10 is far less than the chances that it goes up to 60 because of the momentum that they have going on, as evidenced by the latest order that came in. This is for optical I/O and data center interconnects, all right? And why does that matter? Simple, because that first order that they got, when I called it an AI gold mine, was for AI accelerators. And then they got orders for these optical I/Os, data center interconnects, hard disk drives. Boom, boom, boom. Remember, these were, I don't know if you still have your notes, when I told you about all the different aspects of an AI data center that have semiconductors that need to be tested and probably need to be tested by Aehr at some point because they're becoming increasingly complex and heat intense. And here we have, right? Here we are 1 year later, and boom, they are winning. They're in 3 of those categories that I outlined at that time and getting more and more orders in that regard. So this is still good. Just be careful because we've gone from 7 to 37. The low-hanging fruit is taken, right? We go from 37 to 65, but 37 to 65 is not the same as 7 to 37. Let's keep going. We're at 2:38. Not too bad. Not too bad. We're a little behind schedule, but it's cool. For you guys joining in right now, give me the thumbs up if you like the fact that a 30-year veteran who's been retired since 2008 because I made so much money thanks to the teachings of my mentor and my trusty notebook and pen, taking notes of what he taught me, coming here for free on a Friday in Miami Beach to pass it on to y'all. And all I ask is a thumbs up and let people know that I'm here. Let's keep going. This is a document that I put together. Another thing that AI is great at is going out into the world, finding any shred of information, right? Because Aehr might put out a press release about a company doing business with them, or they might not. Maybe because they can't. Or even if they can, they're under NDA and they can't name the customer. Well, I want to know who the customer is. The great thing about this is that if AI goes out into the world and just looks for clues, right? What did Aehr say in their press release? What did Aehr say in their earnings call? What did Aehr say in their investor presentation? What are different customers saying about Aehr? What are different customers doing to describe the new testing that they're doing on their semiconductors? Does that describe what Aehr does and only what Aehr does? And then AI can help connect the dots and say, you know what? This is probably, in this case, Google or Amazon, right? So when you look at the AI accelerators that they are selling the Sonoma systems into, they don't say who it is. In the press releases, they call it their lead hyperscale customer for next generation AI ASIC processors. AI can go out, look at all the information out there, and determine that this is probably too small on your screen, but this says this is almost certainly Google or Amazon. And then it comes down here, lead AI processor customer. Candidates are AMD or Broadcom. Global NAND leader, flash memory, Micron, Western Digital, or SK Hynix. Lead silicon photonics customer, Intel or maybe Broadcom. It's almost certainly Intel, by the way, because they have a long history with them. And see, that's where I can step in and start narrowing it down further. But those are the types of customers they're dealing with. If you take the least attractive customer out of each of these lists, these 1, 2, 3, 4 major lists, you've got that's a great list of customers that they're doing business with that they weren't 13 months ago. Okay? And so we got all this information, and this is what AI can help you do, help you unpack all this stuff. So that's that. Okay. Also, AI, believe it or not, Crexendo, I've been telling you, it's a boring company, right? Making moves. 2 big announcements this week. Announced a highly accretive, you almost never see this in a press release, highly accretive acquisition of S-Tech. Why highly accretive? Simple, because Crexendo has made a great living of buying out their resellers at a lower price than their valuation. In this case, they bought this company for $35 million. Have your notebooks out. I got some math for you, right? They paid $35 million. The company did about $28 million in revenue last year. Trailing 12 months, not future 12 months, right? Yielding a trailing 12-month multiple of 1.35 times revenue. For reference, that's about half of Crexendo's valuation, which means, all else being equal, as the market starts to price this revenue and profitability into Crexendo's results, Crexendo's market cap should rise because they got a great deal here. Let's talk about how great a deal it was, though, because this company that they acquired has operating margins of about 10%. But because it's a reseller, and because Crexendo has done this a million times before, they know how to very quickly and easily take that company and make it part of their own organization. There's overlaps, there's repetitive expenses that they can take right out of the system, there is cross-selling opportunities that they can put in place, there's all kinds of ways that they can make this company stronger as part of the Crexendo whole. And so as a result, the company believes that they can very quickly move those 10% EBITDA margins, sorry, not operating margins, EBITDA margins, small distinction, up to 15 to 20%. And then push it even further later on, because Crexendo is moving up to a NetSuite ERP system. And once that system is in place, they're going to move these guys off of the existing system they have, and it's going to cut costs even more. And that's going to drive EBITDA margins up to 25%. But wait, there's more, because in the process, the extra cross-selling, the growth of the company's been growing in the low to high single digits. The mid to high single digits. They're going to continue to do that, plus maybe more. Some of the acquisitions Crexendo has made in the past have been companies that are growing at 7%, and then a year later they're growing at 20% because of the cross-selling and being part of the Crexendo whole. So net, I see the profit that they just purchased, right? Roughly, let's say, 2.7 million in profits going to 8 million in profits, which is exactly 3x. That's why I picked those numbers, okay? And so if they're going to triple the net income or the EBITDA number of this company, and they're buying it today at half of their own valuation, it doesn't take a rocket scientist to say that's a pretty good idea. But what I can do is take it one step further for you real quick and give you some math. Assuming that they do get this up to 8 million of EBITDA margin, they are currently trading at about 13x, Crexendo is. So if you go 13 times 8, that gets you to roughly 100 million of market cap value. that accrues to Crexendo. Oh, wait. We got to take out the purchase price, right? Because they're giving up a bunch of cash. That cash comes off the balance sheet. That comes out of the value of the company. It's value out, it's value in. But which is bigger, right? Did they give up more value than they took? Buffalo Bills getting DJ Moore, I think they gave up too much. I don't think that's going to work out for them, right? In this case, they gave up $35 million to get back what I calculate to be $100 million of value. And from the day that that deal was announced, that value gap, the $100 million minus the $35 million equals $65 million. $65 million of market cap profit is equivalent to a 36% increase in the value of the company from the day that it was announced. Now, I think, if I'm not mistaken, the stock is actually up. I mean, the market's been down, so I can't guarantee it, but oh yeah, look at that. I mean, the stock's been doing great over the last several days of this week, up 22% in a market that, here's the same chart for the Russell, has been going down. This is how you make money, folks. Because I saw this news and I was like, this is a extra buy right now. Not just I already like the stock. I love the stock. Buying immediately, right? And hedging my position by shorting the Russell against it, because if the Russell drags all stocks down, if it drags Crexendo down, well, at least I'm going to make a profit on my hedge. I made money on both. I made money on the Crexendo, and I made money on the RWM, which was my hedge against the market going down. This is how you make money when everybody else is losing it. But that's not all. As great as that acquisition was, right? So there we go. 36% of accretion value. We got 22 in just the last week. That leaves another 14% of value that can be had. But wait, that was just from that one press release, and they weren't done yet. Because the next day they announced strong fourth quarter results. And for some reason the stock went down on that news. That was dumb, right? But guess what? As I told you at the beginning of this show, in your notebook, it says, people are dumb. Wall Street is dumb. Investors are dumb. Most of the money flowing through the market is dumb. So when they do something dumb, and your notebook says, here's the smart thing to do, you do what your notebook says, and you win. That's called a contrarian move, right? And so that contrarian move worked out very nicely because they announced that on Tuesday after the close. There you go, right? And there you see the gap down in the stock price. I can zoom in on it for you so you could see. Let's see. There's your gap down. Let's zoom in on it so you can see it clearly. There. Right there, the stock opens the next day and goes down as much as... No, that's not right. Oh, this is the wrong chart. Where is it? CXDO. And part of the reason was, by the way, there's part of the reason right there, right? Because you had the gap down in the stock market. No, actually the stock market gapped up. That's crazy. So the stock market gapped up on the morning of the 4th, and CXDO gapped down on strong results. 8.5%. Crexendo was down, while the Russell, was up. Probably, what was that, 1%? 1%. That was a crazy move. And so people in my community actually reached out to, Mark, I'm buying the stock here. I'm not answering those. I'm not answering, by the way. I'm not going to tell you, right? I'm not going to tell you that's a good move or not. You have to learn these things and do it for yourself. I'm not here to validate your moves during the week. I'm here to teach you the moves on Friday, and then you go off and, do what you're supposed to do. But if you did that, boom, you did great. Because since that gap down, the stock has done nothing but go up 20%. Just 20% in 1, 2, 3 days. That's all. While the market goes straight down in 3 days, what? 1, 2, 3 days, 4% down the market. Gotta love it. Gotta love it. Let's keep going. The results, by the way, they met the expectations on the top line. They beat on the bottom line. Didn't blow me away, but business as usual. Business as usual, but now they have this acquisition to give them some juice. They've got the AI receptionist, which they talked about very bullishly about the reception that's getting, no pun intended. Right? So these guys are very much benefiting from AI. They sell on a session basis, a usage basis, not on a seat basis. So as people get laid off and replaced by AI and the AI takes over those jobs, Crexendo continues to make the same money because the AI will be using the technology instead of the humans. Crexendo's competitors, they sell on a seat basis. So when an employee gets canned for AI, that's a loss. And so makes life more difficult for them. Crexendo's getting stronger. Let's keep going. All right. For those of you that want to go get a beer or something, right? This is important, by the way. This is value here, right? But if all you care about is AI, go grab a beer real quick. Right? This is going to take about 2 minutes. That should be enough time to crack one. I finally, after a lot of work that I've been doing here in the house and all that, finally had time to sit down and said, I need to do some maintenance on my existing positions. And I did, as one of those things, I did a rig fleet acquisition analysis on Geodrill. What I wanted to see was, I've done this a while ago. Right? It's been a while though. I said, Geodrill's got a lot more drills than they used to have. The last time I did this analysis, let me redo the analysis, find out how many drills they have, what kind of drills they have, what are those drills worth, what other things do they have. You got rig packages, integration, all kinds of things. You got trucks that go with it. All these things I put into an assessment, right? And yes, AI wrote the report. But it was based on my prompts, based on my research, based on my double checking to make sure, because what? It's in your notebook. AI cannot pick stocks, but AI can help you pick stocks if you know what you're doing. And I'm sorry, but your boy Money Mark happens to know what he's doing. Bottom line, right? We already burned 1 minute. Somebody's already at the fridge cracking the beer. He's on his way back. We've got 1 more minute to put a bow on this one right here. Bottom line, drills are in short supply right now. Everybody wants a drill because what's happening? Everybody's drilling. Metals are through the roof. Antimony, copper, gold, silver, you name it. If it's a metal, it's going through the roof, right? So everybody wants to drill more metals out of the ground. And the companies that make drills aren't ready for this because nobody wanted new drills for the last 10, 12 years. 2012 was the last boom in gold. Okay, so since then everything settled down and everybody resized themselves and said, yeah, we're going to sell a few drills every year. Now all of a sudden they're getting orders for dozens of drills. Like, yo, pump your brakes. It's going to take us 6 to 12 months to deliver your drill. And they're like, what you mean? Our customer wants it now. And that's why you get somebody like Geodrill coming out and saying on their earnings call that they are operating at full capacity in Chile as they pull copper out of the ground. Okay? Full capacity. You don't see that very often in this space, right? So if somebody bigger than Geodrill, and there are several larger companies than Geodrill, it's a very fragmented market around the world, wants to get drills bad enough, maybe they want to buy Geodrill. And if they do, what's the minimum they should pay? The minimum they should pay is the value of the drills. And since Geodrill has an internal group that fixes and makes sure that every drill they have is operating at full capacity, is in pristine condition. Like Dave Harper likes to keep his drills in like new condition. Okay, so he's got an internal group that keeps the drills operating and in like new condition, which means you could get full value for those drills. Those drills are not losing value relative to what he paid for them, but he is investing money in maintaining them. Right? So he takes half of his cash flow and he invests it in making these drills stay in like new condition. Well, that's interesting because on the balance sheet, he has to, because the accounting rules say he has to continue to depreciate the drills, even though the drills continue to have non-depreciated value. So when I looked into it, tie a bow on it, bottom line is, looking at the types of drills they have, the rig packages that they have, all of the assemblies that go with it, I came up with a number exceeding 200 million as the value of what they have in terms of infrastructure. What's their enterprise value? 118 million. About half. This stock is trading for roughly half of the value of their equipment alone. Their true book value, not book value, real street book value. And that makes sense to me because if you look at my chart on Geodrill, right? That's roughly the distance between here and here. This company, right? They're operating on more than half of their cylinders, right? And yet the stock is trading like they're only operating on half their cylinders. And operating on full cylinder value is $6 Canadian, by the way. This is Canadian. I don't have the American version. GEODF is the American. I don't have that chart in this program for some reason. So let me pull this back and out. And there's how we look on a long-term basis for Geodrill. If they execute well and the value of their drills hold up, right? This is what I love in an environment like this. In a yellow alert environment, it's nice to have companies where your downside risk is limited by the assets they have underlying the company. And I got one more that I'll tell you about when we get to it in my slides. And see, TPCS book value. Put that on the notes. All right, let's keep going. All right, you got your beer? Let's get back to AI. Boom. Here we go. Paramount, right? You had Paramount buying Warner Brothers. It was going to go to Netflix, and then it wasn't. There was that bidding war. Remember what your boy Money Mark told you? Content is king, and AI is not going to kill Marvel or DC. It's going to make them stronger because now you don't have to pay these actors top dollar to play Superman or Thor or Iron Man. Right? You can create an AI character, right? Let's see. Or actor. There we go. Chris Helmsworth, right? Look at this guy, right? You don't think AI can make somebody handsome like this? Sure it can. No problem. Here's the difference. This man right here, before they signed him up to be Thor, was a soap opera actor in Australia. And when they signed him up to be Thor, you know what they paid him for the first Thor movie? $100,000. Do you know how much he's getting now? Let's look. Make per movie. There you go. Oh, I'm sorry. My bad. He made $150,000 for first movie. But 15 to 20 million he's making now. So let's recap. If you discover some soap opera actor in Australia and pay him 150 grand to be the star of your Thor movie, a few years later, you're paying him 15 or 20 million. But if you create an AI actor, nobody who knew who Chris Helmsworth was, nobody cared. Nobody cared who he was. So it could have been an AI actor, right? Proof. You want proof that it could have been an AI actor? Sure, I'll show you proof. You want to see proof? Right here. Remember this?
It's the video that has
right?
Movie stars and sounds like
this is AI. This is AI generated.
He was a good man. He knew too much about our Russia operations.
But
okay, so what's going to happen now is that the top actors, Tom Cruise, he's going to live forever, right? Because as long as people want to see Tom Cruise in a movie, they can make an AI version of Tom Cruise and pay him for that, by the way. But now Tom Cruise doesn't even need to act in the movie. Look at that. He looked pretty good there, right? So instead of pay me $20 million for a movie and I'll show up and I'm going to work for the next 9 months of my life on this movie, he says, go ahead and make an AI version of me. Go ahead and make that movie and pay me $5 million. And I do nothing. And even after he's gone from this earth, right, he can leave it in his will, permission for his family to continue to use his likeness and make $5 million a movie forever. But what if you are not that? What if you are not an already known actor? All the future actors could be AI. All right? So keep that in mind. But anyways, all that to say, I told you that Warner Brothers was going to get bought for a good price. There you go. Great chart there. That's content for you. By the way, I told you before, I own the company that did the Dragon Ball Z series back in the day. There's going to be a lot more Dragon Ball Z coming out now. AI is going to make it a lot easier. The old Dragon Ball Z series can come back. It could be AI enhanced. They could just put the whole old Dragon Ball Z series into AI and say, make it look like new 2026 type graphics, not them old graphics back when y'all were kids, right? And that is TOEAI. That's how you spell it. TOEI animation. It's in Japan. If you have a broker that lets you buy Japanese stocks, it's Japanese symbol 4816. I own that stock. Not in big size, but I want to own some content, right? Nobody can make a Dragon Ball Z with AI. You have to own that content. So anyways, on to the next subject, which is also related to this, which is Paramount says that they're going to release 15 Warner Brothers movies a year in theaters. Okay, so that's 30 movies in the next 2 years. Why is that important? Because before this announcement, the expectation was closer to 20. So they are increasing by 50% their commitment to how many movies they're going to be releasing, Paramount, with Warner Brothers under their wing. Who is that good for? Dun, 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 dun. Our good friends at Aehr. Because Aehr has been doing what? These movies for Warner Brothers. Superman, F1, we talked about that before, right? And on top of it, here's the interesting thing that goes along with it. Not only are they doing all these Warner Brothers movies, but when I told you about the F1 movie that they did, that they sent 250 influencers to the red carpet event for F1, right, and got paid for that. 250 influencers, right? Sounded pretty good. Well, Warner Brothers paid for 2,000 influencers for Wuthering Heights. 2,000. You went from 200 to 2,000. They're spending more and more and more money on the influencer channel. Why? Well, obviously stupid, because it's efficacious. They're getting a return on their investment that's like, whoa, that campaign drove a lot of ticket sales. Let's keep doing this. Kind of like when Facebook came out, and if you put a Facebook ad out there, you got 5 times your money on those ads, and people started doing more and more and more Facebook ads, right? To the point where Facebook started raising the rate that they charge for those ads. Well, guess what? That's what's happening here. Do you want further proof of this? Well, I can give you, let's connect the dots. First of all, just to confirm, oh, there's Wuthering Heights on the Aehr page. There's Wuthering Heights on the 2,000 social media influencers. And then just to top it off this week, the Wall Street Journal putting out an article talking about the power brokers behind the 250 billion influencer economy. They didn't name Aehr by name. They talked about the industry, not the actual players, but they alluded to the players. And what they said was, right, that you got all these influencers. They start the article. You can read it on your own, right? This 24-year-old with 1.6 million TikTok followers. She's making money on advertising, but she is represented by an intermediary, because Kate here isn't going to reach out to Warner Brothers, and Warner Brothers isn't going to answer the phone. But a company like Aehr can. They are the intermediary. They are managed by a management team that worked for one of the largest advertising agencies in the world. The company that made the Marlboro Man, right? This is a Manhattan, Fifth Avenue advertising giant that these executives came from to join IZEA to be the middleman, a power broker behind this $250 billion growing influencer economy. So that was really nice to see in the Wall Street Journal of all things, right? When you've got a company like that. I spoke to the CEO and we had a great conversation about this, how AI is really helping his business because it allows those influencers to make advertisements, to make posts that look like Hollywood quality videos. And now they can compete with the big boys in terms of the content they create, that gives them more influence, that gives them more followers, that gets them more interest from the Warner Brothers of the world. Okay, so I did a little report. Look, you can just put that Wall Street Journal article into AI, ask for a summary and what it means for IZEA, and you'll get an answer, just like I did here. I read it, I'm not going to read it for you here, but it just kind of gave a little bit more color on all this. But prime positioning as a power broker. That's all you need to know. So boom, there you go on IZEA. Stock acting great, by the way. And what's really interesting about this is that from where we're sitting right now, IZEA has $3 in cash. The stock's trading for $4. If you look at the private markets, and I talked to the CEO about this, he actually brought it up himself. This is really crazy because if this was a private company, the valuation on this stock would be closer to 10 than 4. Okay? That's just math. It's just math. So, and by the way, the last thing I'll say about this is, as they start to make acquisitions, as they start to bring in additional pieces to make that power broker empire bigger, right? IZEA is sitting on over 100 million in NOLs. What's that? Those are tax credits. So as they start to make more money, as they start to make more profits, they don't have to pay taxes on that for a long time, Jack. So they can go out and acquire companies, and as long as they can create some synergies there within their own organization and create profits out of that, those profits are going to come tax-free, which means it makes it that much easier for their acquisitions to be that magic word I used with Crexendo earlier, accretive. Put it in your notebook. On to the next AI stock, Gatekeeper. This one's been getting smoked. Glad you guys followed the rules and lightened up on your positions back when the stock was ripping. I've actually changed the risk-reward chart on this slightly to reflect maybe somewhere around here, right? Just to be a little more cautious, just to be a little more conservative in this yellow alert environment. But we're still up here at 3 as the top of the line. That is consistent with the Wall Street price targets. Now that they're getting plenty of Wall Street coverage, you see the stock looks like death. You got a death cross. It's under the moving averages. The stock's come down from 225 to just about $1, right? Nobody likes Gatekeeper. I mean, it's funny because up here, everybody loved Gatekeeper. And down here, everybody hates Gatekeeper. That's the opposite of what Warren Buffett teaches, by the way. If you love a stock at 2, if you like a stock at 2, you should love it at 1. That's right. And what has happened? What has changed in this story since here? Aside from, they did that offering, and I thought that was a mistake, right? The CEO thinks he needs the money because he wants to expand. Okay. And maybe it's harsh for me to call it a mistake. I just didn't like how it was done. Let's put it that way. I'm all for growth capital. I'm all for bullish raises. But you got to be careful how you do it, or you're going to get your stock smoked. And when you get your stock smoked, some people will run for cover. And a lot of times when people run for cover, they don't, or it's harder for them to want to come back. All right, so they lost a little bit of their shine. That doesn't change anything about the company, their prospects, or what the proper value on the stock should be if and when they are operating on all cylinders. So that's all I got to say about that. And in the meantime, they announced a follow-on video contract. Wasn't big, but hey, better than a kick in the ass, right? $250,000, another win for them. Nothing crazy, but hey, we're going to report on everything. Even though we're behind schedule here to get to Q&A, which let's get back on track for that. So let's see what else we got. We got one more thing here. Electric boat. Oh yeah, what I promised you earlier. So Electric Boat, who makes all those submarines, is getting close to a new deal with the government. The government put the beat down on them because for decades, since the end of the Cold War, these damn contractors have let their backlog build up, and not be delivering things on time. Why? Easy. Because they want to have that sure business. They want to live high on the hog and just be fat and just sit back and let the backlog be big. They want years of backlog so that they know that their jobs are secure. Well, that's not good for U.S. security. And now the Trump administration, and I'm not biased one way or the other, right? This is all business. But the Trump administration came out and said, nah, y'all ain't doing this no more. This is a matter of government security, right? Crucial interests. You cannot live on your backlog anymore, or I'm going to make life hard on you. And next thing you know, Electric Boat's going, yes, sir. Buying a bunch of land, bought a Macy's, bought a mall, expanding their footprint to do what? To increase, to accelerate the pace at which they can make submarines, because the government's been complaining for years, we want more subs, we want more subs. And Electric Boat goes, yeah, we're going to make more subs. But then they don't. They go, we're going to build the backlog. And they let the backlog build. And then Trump came in and said, nah, you ain't doing that no more. And boom, here we go. You want another deal with the U.S. government? This pending multi-ship contract for 15 submarines? We want assurances in the contract. We want penalties in the contract. You guys are going to go broke if you don't give us what we want. And so we're a couple months away from that going through. And I've already shown you before what that impact is on the expectations. We had Columbia-class submarine production double versus last year after being flat for year after year after year. We're going to see the same thing presumably happen with the Virginia-class subs. The government wants, right now, they want 2.3 subs a year. They're getting 1.6. I don't even have them going to 2.1 for another 2 years. But if it happens, if all this ass kicking gets the ball rolling, then we could be well beyond 2.1 in 2 years, probably should be, right? And what does that mean for TPCS revenue? Through the roof. What does it mean for TPCS? EPS? Through the roof. By that time, they could do $1.50 in EPS. In the meantime, we've got a very similar situation as we have with Geodrill, but even better because they are at their green line now, number one. And number two, the government has given them $23 million of free money. And just so you know what that means relative to the stock, this stock has a market cap of $35 million. And they already had, by my estimations, a solid $25 million of equipment value. Forget about the balance sheet. You want real world balance sheet. Right? So you had a $35 million market cap, you had $25 million in equipment, and then the government gives them another $25 million roughly. They've got like $50 million of equipment that is all itching to be used by these government contracts that are being put in place. And the stock is trading for $35 million, not $50 million, which should be the bare minimum, but $35 million. Why? Because they've been kind of bozo-ish. Right? They're not executing the way that we like, but they're making progress in that direction because the activist investors came in, replaced people on the board. Right? We're going to continue to see that. You will probably see new board members nominated for the next board proxy fight, and they'll probably, be a little smarter than they were this year and get even more people on, because they did a great job last year. They got those 2 people on the board. Then this year, they didn't put that same effort in. Next year, they're going to learn from their mistakes. And what's going to happen? Right? I'm going to get my proxy statement. I'm going to get an email or a text or another letter that says, hey, look for your proxy statement and vote for this guy and this guy, because we got to get rid of these other clowns and make more of a difference. And we're going to make more of a difference. And what happened? From the time that they did that last time, this stock went cuckoo. We had a over 100% gain from that. And since that time, right, you got to pull back. People take profits. The momentum comes out of the out of the sales. And next thing you know, the prospects of the company are still strong, and yet the stock is at the green line level and trading for well below the street book value of the equipment that they have, that the U.S. government absolutely needs to have operating to get the submarines, submarines, helicopters, and fighter jets that they want and need. Oh, and there's just a little war going on in the Middle East, so and we had 3 F-15s crash into each other. Luckily, nobody died from the U.S. side. They all got ejected safely, 2 from each fighter jet. But now we have 3 less fighter jets. So we now need more fighter jets. What are we going to do about that? Well, I don't know, man. Maybe we'll order more F-15 fighter jets, which TPCS makes money. Every fighter jet is worth about $750,000 of revenue to TPCS. That means that crash was worth about $2 million of revenue to TPCS. That's close to 10% of their annual revenue. Okay? So yes, the management team is still not operating on all cylinders. They're making progress. It's slow. Hopefully it accelerates, but at the end of the day, they have these contracts, they have this need. 91% of their revenue comes from parts that they make, where they are the only company on earth making those parts for these products. So use your heads, ladies and gentlemen, use your notebooks, use your pens. All right, next up, boy, we are really late. We're going to go straight to the lightning round on Q&A. I won't have time to talk about Kraken too much, so I'll give you the quick story. They made an acquisition, and that acquisition is going to be very interesting and strategic for them, because now not only are they going to be providing the batteries for these submarines, but I think it's the guidance systems. Don't quote me on this because I didn't have time to prepare for this. I had the notes somewhere and then I lost it. But now they're going to be providing more. So each one of the subs that they provide batteries into, they've got even more stuff that's going to go into it. They got the sonar, they got the batteries, and they got this thing that they just acquired. So I just haven't had time to look. We're already an hour and 15 minutes into the show, and I'm still not done telling you everything that I learned. Never mind the stuff that I didn't have time to learn this week. So I just wanted to give you a preview on that. Moving on, we got Birch Tech, BCHT, speculative name, and hasn't worked out. Shocking. But now we're at a valuation level where it's very interesting. And by the way, they did an offering, and the CEO himself had to file with the SEC because he himself participated in the offering to the tune of 300,000 shares at $2.40. All right, here we are sitting at $2.26. He put his money where his mouth is. That's that. What's that add up to? That's about close to $800,000 when you multiply that out. So there you go. Either that's $800,000 that he's incinerating, or he's confident that this is a great price for the stock if you're into that sort of thing. All right, that's about it. We're going to go to Q&A. This, by the way, is just an industry report that I'm reading about the explosion of ambient IoT and physical AI in the supply chain. Okay, so this is a new thing that's going on. In my pursuit of continuing to keep you ahead of the curve on what's happening next in AI, I was telling you about Isaiah, right? And what AI is doing to make that influencer economy blow up. Next thing you know, a few months later, the Wall Street Journal is reporting on it. We were ahead of the curve, right? Also ahead of the curve, you've got this industry report, right? I'm looking at, and this goes back to my days at AMR Research, an independent third-party industry expert in the realm of technology, specifically software and supply chain. Okay, and back then Walmart was a big customer, and they wanted to have everything tagged. If Walmart had their druthers, they would have every single item that they own have a tag on it so that they can measure and map where is it, what's the temperature, what conditions are it in, is it dark, is it light, is it on a dock, what's going on? Because if you connect all that information to an AI system, the AI system can provide notifications of things that are going on. So for example, I'll give you an example, right? Imagine a world where they could put a tag on a pallet of lettuce. And that pallet of lettuce gets onto a truck, is 40 degrees in the truck, and the lettuce is heading to the Walmart stores from the distribution center. And somewhere along the way, the refrigeration in the back of the truck goes out, and the temperature in the back of the truck starts rising to 45, 50, 55 degrees. And the sensor notices it and sends a message, not necessarily to a human, but to another computer system that sends a message to the actual truck driver and says, yo, there's something wrong in the back of your truck. Go check it out. And the truck driver goes back there and maybe he notices that the door was left a little bit open or something. And that was letting the cold out. He closes it up, sends a message back to the text that says everything's okay now. And that message doesn't go to a human. It goes to the AI system that says, okay, let's check it out. And then it notices the temperature dropping back down towards 40 degrees, and then everything's good. Walmart can save tens of millions of dollars per year on the bottom line if they could get their arms wrapped around that fantasy I just told you about. Except it's not a fantasy. It's real. The tags that Walmart was looking at back in the day, it was RFID. Back in 1998, I remember, right? Now, they got these tags, and they weren't cheap. You wouldn't be able to put them everywhere. You can get these tags now, 10 cents or less. So now you can put it everywhere. You might even be able to afford to put them on each head of lettuce. Now, we weren't going to go that far, but definitely on the boxes, the pallets, what have you. Anything that's worth putting a 10-cent tag on, you can put that tag on, and now you can monitor everything that's going on with those items using not people, but AI, and save tens of millions of dollars in your supply chain. Okay? So who benefits from this? We'll see. I'm starting to dig deeper into this, but this is how you do research. You find out what is happening. 1998, Walmart wants to track everything. That's the supply chain, the physical supply chain, right? And what is the catalyst? The tags have to become cheaper. The computer systems have to become more intelligent. Next thing you know, 20 years later, 28 years later, the tags are dirt cheap. And now we have AI. Both of those things I just said come to fruition. The price collapses. The intelligence goes through the roof. And now Walmart can, boom, send this stuff everywhere. And that's going to be a boon to several companies out there that provide the technology infrastructure that goes into this stuff. If you know companies that are involved with this, do not mention it. Do not put it in the chat. Do not do that stuff. We will talk about that in the future. Hold those names to yourself. You can buy the stock knowing that we're going to be talking about those stocks. So why would you tell anybody now and ruin the surprise? Don't do that. But stay tuned, y'all, because this is the type of research we do. You don't see this going on behind the scenes, but I wanted to give you a taste of the kind of stuff that we do and how we start at a top level view and work our way down to find a winner, not from the bottom, looking at a company that has a CEO doing a presentation, a dog and pony show saying, look at why we're great. And then you say, wow, that sounds beautiful. No, that's not how it's done. That's how you get duped. That's how you get suckered into buying stocks that end up doing offerings and go down the drain or in wait time that are not the leaders in their space because you are starting from the wrong position. The position of somebody telling you about a company and having that company tell you why you should buy their stock instead of you starting from the industry perspective and working your way down and figuring out who are the best of the best in this industry who are gonna make money whether they like it or not. And then you don't even have to talk to management. You just know they're going to make money because they're in the right place at the right time. Let's go to Q&A. We'll put Isaiah up here as the chart for now until somebody asks for something else. Let's see what we got for Q&A. I will not answer dumb questions. I will not address dumb questions. We don't have that much time. We got about 30 minutes, and so I don't have time for dummies or the dummy treatment or all that stuff. Let's see. Yeah, man. It's a question on IWM and asking, it looks like that the technical channel is broken. Yeah, and what's your point? The technical channel is broken. That doesn't mean anything to me, by the way. That might scare people, right? And it might tell people, well, the next support level is down here or down here at the 200-day moving average, blah, 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 blah. Yeah, I put that stuff in there as a guidepost to give me a little view into what's going on and how a lot of people might be thinking about it. I'm not going to teach you that stuff here. You're going to see it on the screen as a frame of reference. But I don't know what to do with this stuff. I'm not a day trader. And when I wasn't a good one. I'm not good at technical analysis, and 95% of you aren't either. You're not born to be great at it. It's in your blood. It's called fight or flight. Your great-great-great-great-grandfather survived a lion attack because he saw a lion and ran the other way before the lion saw him. The bonehead who saw the lion said, that looks kind of cool. I'm going to go pat him. He didn't live, and so he didn't have a kid, and so you're not his great-great-great-great-great-great-grandson. You're the great-great-great-great-great-great-grandson of somebody who knew better because of his fight or flight response. But in the stock market, the fight or flight response makes you run away from danger. A falling stock is the lion in the modern society. And that's why people are kind of programmed to sell a stock that's dropping out of fear and jump into a stock that's rising out of euphoria. Emotions, which have no place in the stock market, live long and prosper by acting like Spock. All right? So I'm not answering the rest of that question, my man. Asking me if I've got a Carl Guttag for drones. Who was my independent? I don't talk about that stuff. Like, I talk about Carl Guttag as an example, right? And I talk about Castellano as an example. I've got hundreds of sources, but I don't want you to know all of them because I want to be the one to find the best stocks first. I'm going to share with you, but if you want an independent third-party expert, you got to find them. All right? That's just the way it works. I'm here. I give you all enough. I hope it's enough. I answered the question about Kraken. And look, I mean, to answer your question, what has it done to my interest level? Not much. I mean, I might want to move this line up here, right? But I just got to a certain point where I didn't have enough independent third-party expertise to fully grasp what this company is really worth beyond where this line was, right? And as a result, we got us in at 67 cents, thereabouts, and out at $2. It was a triple. Right? And then it tripled again to 6. Right? What does that tell you? Obviously, Mark's not a pump and dump. He wasn't just pumping the stock from 60 cents to $2 because when I said that's all I can justify, the stock kept going. And I told y'all many times, right? I'm out of the stock, but I'm afraid, which is an emotion, so I can't act on it. I'm afraid the stock will keep going because it has that kind of feel to it. I just can't put my finger on it. I can't put my pen and a notebook and a calculator to it and guarantee you that I can put lines on this page that I feel confident in putting you in front of. Okay? I'm not here to hype stocks. I'm here to help y'all make money. For real. Okay? And so what does that mean? That means that there's going to be times when I get you out of a stock early before it gets to 52, right? I'll get you from 2 to 22, and then it goes to 52. That ain't, I can only do so much. It's called the low-hanging fruit. I like going after the low-hanging fruit. And then those stocks keep going, right? My first public pick after seeking alpha in my spreadsheet was Facebook at 18. What's Facebook now? It's not even Facebook anymore. It's Meta. 653. I picked this stock at 18. I got out at 57. It's now 643. I pick good companies. I try to pick good companies. So when I sell out of those companies because I'm uncomfortable with the valuation being low-hanging fruit, it doesn't mean that the company can't continue to perform well. And Facebook has, obviously, right? We got in. I'm almost bottom ticked it. It was 18. The stock went to 57. It was like a triple, thereabouts, right? That's where I got out. And since that time, the stock, you see the box over my head? Look at the word annualized. And you see the number next to it? Plus 22%. So you dummy, Mark, you sold at $50 and the stock went to $650. You're an idiot. No, I'm not an idiot, because the stock only went up 22% a year since then. My money went up 40. So if I kept my Facebook, it would have been an underperformer in my portfolio. Sounds crazy, right? But the 54 bucks that I got from my Meta stock, whatever it was, 54, 56, 57, 50 something dollars a share I got from my Meta stock back in 2014, that 50 something dollars is now worth way more than 650 bucks. It's something closer to, you want to see what 40% looks like? I can't even show you on this page. Maybe I can now. 40% a year. If you make 40% a year off of the 54 bucks that you sold that Facebook stock for back in 2014, you now have $3,393, not 643. So was it dumb or was it genius? That's how it works, right? So when I got rid of Kraken, yeah, it wasn't the best move in hindsight, but only hindsight's 2020. It would have been a great move to stay here. Right? In this particular case, because the stock has continued to move at 162% annualized. That's more than my 40% annualized return. But by the way, I probably did 162% last year, so it's not a big difference, right? We all made crazy money last year. So that's how you do it. You go after the low-hanging fruit, right? You don't do the FOMO thing. You don't worry about if it keeps going. I don't regret that I sold at 2 and now it's 6. I don't regret that, because there's no room for an emotion like regret, because that money went into something else, and the $2 I got for Kraken probably is now worth $5.50, maybe 6. So it's a wash. No big deal. All right, let's keep going. Geo is down. Is it impacted by the increase of oil price? That's a fair question. It's possible, right? Because what's happened here is, let's look at gold, GLD, right? GLD's off its highs, all else being equal, right? Higher gold is good for demand. What's good for demand is good for Geodrill. But as I've told you before, and it should be in your notebook, anything above this line, we were bullish on Geodrill when gold was down at these levels. And now gold is up at these levels. And don't be surprised if gold doesn't get above these levels. Maybe there's only $100 left in gold if you look at the historical chart of gold. But it doesn't matter if it comes down. What matters is if it comes down all the way down to here, which probably doesn't happen because that's the lower bounds of this line. We are in a position now where demand for Geodrill should not abate for years to come, because there's all that cushion in the demand for their services. But to Sylvie's point, great question, a lower gold price means less revenue for those customers. Higher oil price means more expenses for those customers. So on the margin, has demand for more drills decreased ever so slightly in the last couple of weeks? Sure. But the trend is still in place. So I wouldn't worry about that one bit. In fact, I don't, especially when I'm paying 50 cents on the dollar for the drills that they own, never mind the customers, contracts, management team, and business that they have, much less the possibility of them being acquired. This company, to me, is worth a lot more than what it's going for right now, with strong downside risk protection. Excuse me. As there are tailwinds on the shipbuilding sector. Which is bullish for TPCS. What is your point of view on ship welding stocks? I don't have to answer that. You answered that question in the midst of the question. What's my point of view on MyTech, which complements IDN? I don't know MyTech. You said earlier many times Kraken might get acquired by some large players. We talked about Kraken already. I said what I said, and that's all. I gave you all I got. Wasn't Dave going to sell when he hit 100 drills? Yeah, that was the plan, Dave. But the fact of the matter is, business is going too well. They're growing. Man, I'm stumbling over words and sneezing all over the place today. He figured that by this time, by the time he got to 100 drills, maybe he'd only be growing at 5% a year. But he's still growing in the strong double digits. So it's still fun for him. The industry is in an uptrend, right? He's having a blast. So who knows, right? Maybe he goes to 120 drills. But that's good because then the company will be worth 20% more at that time. I don't care when Dave sells the company, right? As long as he keeps executing and keeps growing the business. Because as he does that, the stock keeps going up. And what do we got here? All else being equal, the trend lines grow at 9.6% a year. That's my downside, right? For me, my downside risk here, me buying his equipment at 50 cents on the dollar, how can I lose? How can I lose is that the stock only tracks the 9.5% that the stock has gone up over the long period of time. What kind of risk is that? In an environment where your money market funds pay only 4%. I'm getting 9.5 here, right? Oh yeah, so for that that ticker symbol for the Japanese stock that we were talking about earlier, it is TOE. TOE. It's not going to come up on my charts, but I can show you the symbol right there. TOEAF. There it is on your screen. So if you want to invest in the Dragon Ball Z stock, that's the US symbol for it. Mark, do you believe Intellicheck's recently released Windows-based, no integration needed desktop version of their fraud protection tool will be a game changer, making IDN juicy buy at this price? Game changer? Nah. I mean, if it was, I would have came out and told you that, right? So, by the way, there's our chart on IDN. By the way, I haven't reinitiated, right? I graduated the stock, didn't drop coverage. There's a difference. I dropped coverage on loser companies like Ecor that lie to people, not on companies like IDN that I still like, but get to price levels. It was 667. It was exactly 667, right about there, where I said, you know what, this is too much of a move, too fast, let's get out, we can get in at a cheaper price, and lo and behold, here we are, 28% down. I didn't even realize. The stock's gone down 28% since I told you to take your profits. Beautiful, right? Sitting somewhere near the 200-day moving average, so hey, you know, it's obviously more attractive than it was when we got out at 667. I might have to do some work on this. I haven't had time to. You see how much work I gave you guys this week already. Went way overboard. Usually 1 hour to tell you everything I learned in the week. Took over an hour and 15 minutes this week. On to the next week. Do you think Mag 7 CapEx tempers within the next 2 years? That is a good question. Do I think the AI CapEx tempers in the next 2 years for Mag 7? I don't know. But what I do know is that I've spent the last 2+ years telling you AI is not a bubble. And today I will tell you AI is not a bubble more than ever before. Right? I mean, look what's going on. AI is writing software, scaring people into thinking that Salesforce.com is going out of business. Making movies. I told you it'd be 10 years. 2 years ago, I told you that in 10 years, AI would be making feature-length Avengers movies. And now we already have them making trailers with Tom Cruise and Brad Pitt in them. How much of a stretch is it from there to make a full movie? We might have a full movie in a year or 2. Never mind 10. In other words, AI is greatly exceeding my expectations from 2 years ago when I said AI is not a bubble, when Nvidia was $42. Now 177. Okay? And yes, it's an important question. Will AI CapEx continue to be as strong 2 years from now? Sure, it's an important question. But right now, nobody knows the answer. All we know is that the momentum behind AI continues unabated. And until we see a slowdown in the momentum behind what AI can do, I wouldn't even think about CapEx going down, because CapEx is still going up, not down. Okay? So when I tell y'all that AI is not a bubble, it's a build-out, there's a big difference, because bubbles burst, but sometimes build-outs just turn into the standard operating procedure. And that's what might happen. AI might continue to grow in its capabilities so fast that this build out phase that we see just continues and continues and continues. Okay? Because clearly the companies, the Mag 7 has underestimated how much money they should spend on AI. So the people that thought it was a bubble, well, guess what? They were wrong. It was the opposite. AI is the opposite of a bubble. It has been underappreciated. And as a result, the Mag 7 is increasing their spending, not decreasing their spending. And until we see at least them start flattening it out, or at least the momentum in the increases start to decrease, that's called the second derivative. Write it down and look it up, right? Until the second derivative of AI CapEx goes flat or negative, there's absolutely nothing to be concerned about here, except valuation, as you can see on the screen, where I told you that NVIDIA was not a great buy at those levels and hasn't been. If you bought NVIDIA 6 months ago, you're not making money. You haven't been making money. Look at that. From the red line level, it's been 7.5 months of no profit. That's a waste of money. We've made crazy profit in the last 7 months and a lot of other stocks that are not known like NVIDIA. Is BCHT in wait time or gold mine for their water expansion? I'm going to let you answer that question. Go into ChatGPT or Perplexity or anything like that and ask it, how much momentum is there in BCHT's water business? Has it hit an inflection point? Or is it just getting started? Have they done enough to say this business has reached escape velocity, or is it still a show me story? Just ask it like that, and you're going to get the answer, right? I'm teaching y'all how to fish. Sometimes I'm not going to give you a fish. We're coming down to the last questions. We're coming down, we've been here a little over an hour and a half, so it's cool. Put your last questions in the queue. I'm not going to ask again. This is the last call for alcohol. After that, signing off. I'm going to go have fun with my kid. All right. Curie, charts, AI library, licensing per minutes have gone up, partners to double. That's not a question. Michael, you idiot. You idiot. I told you to follow instructions. Okay? This is not following instructions. You know what? And I feel bad because I'd like to give you a warning. I haven't seen you here before, but once in a while you got to put the beat down on somebody. I am going to kick you out of being able to ask questions. Sorry. You're in timeout. Maybe I'll let you back in. But unless you can follow instructions, I'm a multi-millionaire making millions per year. Okay? I got paid $3,000 an hour for my services. And I come here and give all of you 2 hours of my time every week. And the only freaking thing I ask you, idiot, is to take a pen, T-E-N spells pen, and a notebook, N-O-T-E spells note, and write down what I say and follow instructions. And you come in here and you put your 3 question marks in front of a statement instead of a question. And if it was a question, I'm sorry, it made no sense to me. It was just it was like a bunch of words. I read it word for word. Did that make sense to anybody? Yeah. You didn't think you were going to get the dummy treatment, huh? Well, sometimes I feel like giving the dummy treatment. And you get the dummy treatment. And in this case, I'm sorry, but it's like I know you're probably the first time question asker, but this is for all you first timers out there, okay? Every once in a while, I'm going to slap one of you rookies in the face. I'm not going to go easy on you all the time. I beat up the vets, and the vets have learned. I mean, look at this. This has been a clean show. No, not many, I didn't have to skip many questions. They're good questions. You veterans are following the rules. You're giving me the thumbs up. You're sharing the invite. You're playing the hashtag team. But if you're lazy and you're going to ask me about companies I don't cover, you're going to put comments about your stocks, you're going to ask me questions that aren't questions, you're going to get slapped in the face because you don't show respect for my time. This 1 minute that I just spent yelling at you is $50. when I used to charge institutions, 60 minutes divided into 3,000 an hour, that's $50 a minute. Okay? You owe me $50, stupid. And on that note, and by the way, don't take it personally. It's all part of the show. Anybody will tell you. You guys can tell them in the chat. It's all part of the show. Don't take it personally. I will get you out of timeout at some point. Okay? But learn. Get your pen, get your notebook, and learn, because we are competing against a bunch of idiots out there on one side of the equation. Like 75% of the money is dumb money doing dumb things. CXDO, you saw it, right? And the other 25% are that smart, Wharton, educated, three-piece suit MFers in New York City. We can avoid them. Don't have to compete against them. Let's compete against them and make a whole bunch of money every Friday with Money Mark on Stock Talk Live. Maybe see y'all next week. Hit the like and subscribe button and the notification bell. That way you'll know, because I'm not going to come here every week, right? But when I do come back, it'll be Friday with Money Mark on Stock Talk Live. Have a great weekend. Take care. All right, what do we got here? 346. We're making money. The market's down. We're up. What? Come on. Let's see what we got for movers today.